can see my presentation. So just give me one moment, please. Sorry, just one second. Okay, I think you can all see my screen, yes?
Sí.
Okay, perfect, thank you. Okay, so I'm just going to go back one. So I'm going to be talking today about a very general overview of the tax implications and the tax obligations of coming to Canada. So you've already heard all about me. There's my bio for those who are interested. I've been practicing tax for just over 20 years. And as Natalie said in her introduction, I do specialize in advising Canadian businesses and individuals on Canadian tax matters, as well as people who are looking to enter Canada, either as individuals who are immigrating to Canada or businesses who are looking to carry on business here. Again, we cannot and are not providing specific legal advice in this presentation. So we're happy to assist you with your specific legal issues and questions, of course, and are pleased to do so. Okay, so here's the agenda. We're going to talk about what entities have jurisdiction to tax in Canada, the types of tax that are levied in Canada. Then really the meat of the presentation is a taxation of the various forms of business organizations in Canada. We're going to talk about our value added tax, which is the goods and services tax, as well as payroll taxes and other withholding taxes that that apply in Canada. I'm going to touch briefly on tax treaties and finally end with the Investment Canada Act and its application. So there are three different levels of tax in Canada. They're levied at the federal level, which is the national level. They're also leveled at the provincial level. Generally at the provincial level, those are income and sales taxes that are imposed. And then at the municipal level, so at the local city level, generally the types of taxes levied there are property taxes on real estate. There are three different kinds of taxes: income tax, excise tax, which is our value added tax, and payroll tax. And I'm going to speak briefly about those different types of tax and how and when they apply. So income tax in Canada is based on a taxpayer's residence. And residence is generally a question of fact. So there is actual, there also can be deemed residence for Canadian tax purposes, but there are a few specific rules. For example, a corporation is deemed to be resident in Canada if it was incorporated in Canada. A corporation that is incorporated outside of Canada may still be considered a resident of Canada if its central management and control is located in Canada. So a non-resident corporation may still be subject to Canadian tax as a Canadian resident, depending on the facts. As Taras mentioned in his presentation, Canadian residents are taxable on their worldwide income from every source, and that includes business income, property income, investment income, capital gains arising from disposition of capital property, for example. So all income is subject to Canadian taxation, regardless, excuse me, of where the property upon which the income is earned is located. Excise taxes are a value-added tax. At the federal level, it is a value-added tax of 5%. and it is imposed on goods sold or rented and on services provided in Canada. And it is imposed at what's called the place of supply in Canada. And I'll be talking about that a little bit later on when we talk about GST. And then payroll taxes are taxes that are imposed with respect to employees. So payroll taxes include employer and employee contributions to Canada Pension Plan, employment insurance, excuse me, I'm sorry, and employer health tax in Ontario. So those are the different levels of tax. Now, just by way of summary, because to remind you of what Taras has already spoken about, I'm just reminding you of the 5 main forms of business organization in Canada. So we'll start with the first one, sole proprietorship. It is unlikely that any of you will carry on business here in Canada as a sole proprietorship, but essentially, income of the business is taxed in the hands of the proprietor. And business expenses can be deducted from business income. So in essence, a sole proprietor is identified directly with, the business income is identified directly with the income of the sole proprietor and the activities of the sole proprietor. So a partnership, again, partnerships may be a viable business form of organization for you to the extent that you want to carry on business here through a partnership. A partnership interest, a partnership organization or structure is taxed as a flow through. So the income that is earned in a partnership is flowed through and taxed in the hands of the individual partners themselves. And it could be individuals as natural persons or individuals in the sense of corporate partners. So you don't necessarily have to have a partnership that involves only individual persons. You can have, obviously, corporations be partners in a partnership. The main issue with the taxation of partnerships is that the income will flow through the partnership. So the income and losses are determined at the partnership level, and then income and losses are flowed out to the partners, and they are going to be applied, obviously, pro rata based upon the percentage ownership that each partner will have in the partnership. And of course, if you are carrying on business through a partnership, there is the risk of personal liability with respect to the activities of the partnership. And also with respect to unremitted goods and services tax or other taxes, goods and services tax of the partnership. Okay, so a joint venture. A joint venture is similar to a partnership, but Canadian law does not recognize a joint venture as a distinct form, of business organization. A joint venture is an arrangement between 2 or more parties who share in a common venture. It's usually a contractual relationship, and profits and loss are not calculated at the joint venture level. The taxation is at the individual co-venturer level. So it is similar to a partnership in the sense that the tax obligation is a responsibility of the individual co-venturers, whether natural persons or corporations. Okay, so now we'll move on to a branch. A branch is an unincorporated a branch is not a separate legal entity. In essence, a branch involves the foreign entity carrying on business in Canada. So a non-resident corporation that carries on business in Canada must pay Canadian income tax on the income earned in Canada. And I'm going to speak a little bit about how one is found to be carrying on business in Canada for the purposes of a branch. So one of the issues is whether the branch has a Canadian permanent establishment and is therefore subject to Canadian tax. So that's a question of fact, and generally a permanent establishment is a fixed place of business through which the business of the non-resident is wholly or partly carried on. Tax treaties generally provide that a permanent establishment includes a place of management, a branch, an office, a factory, or a workshop. So if you have any of those forms of organization in Canada and you're operating through a branch, you will likely be found to have a permanent establishment in Canada. There are certain things that do not constitute a permanent establishment, but generally a place of management, an office, will be considered a permanent establishment. Depending on the nature of its activities, a branch operation will often have a permanent establishment in Canada. A permanent establishment can arise in many other circumstances. For example, the Canada Revenue Agency considers that computer equipment, such as a server that connects to the internet, to be tangible property having a physical location. So if you carry on a business that is entirely carried on online, depending on the location of your server, you may have, a server may constitute your place of business if it is owned or leased and used by the non-resident. On the other hand, the mere use of a computer or server owned by a third party will not generally constitute a fixed place of business. So as Taras said earlier in his presentation, one of the favorite things that I like to say is that it depends, because in tax, it all depends. Although there are, of course, many general rules with respect to the application of tax, in most cases, it is very particular to the specific facts of the organization that is looking to carry on business here. And that's why we can't give a sweeping generalization about whether Canadian tax will or will not apply. It really is very, very significantly fact dependent. Another issue that, or another factor that may constitute a permanent establishment are agents and employees. So if you employ people in Canada and these people have and habitually exercise authority to conclude contracts in the name of the non-resident, then these agents and employees can themselves constitute a permanent establishment in Canada. So as I previously mentioned, a branch is not considered a separate legal entity, and the financial and tax accounting for branches may be more complex than for a Canadian subsidiary, which I'll speak about next. For example, the determination of a branch's proportionate share of the corporation's overall general and administrative expenses can raise difficult questions. Non-resident corporations wishing to carry on business through a branch face the potential problem of preparing financial statements for the branch that are acceptable to both the Canadian taxation authorities and the tax authorities of the country of residence. And this is, quite frankly, quite a common issue that arises, especially where you may have different forms of reporting, such as consolidated financial reporting in the United States, whereas we generally in Canada don't have consolidated financial reporting and will require the financial reporting to be consistent with what is acceptable here from a tax perspective and from a filing compliance perspective. Where a corporation carries on a business through a Canadian branch, all of its books and records with respect to the Canadian operations must be kept at its Canadian place of business or other designated place, and they must also be made available for audit by the CRA, the Canada Revenue Agency, pardon me. The taxation of non-resident employees of a branch will depend on whether the employees are or become Canadian residents. So that's another consideration, that employees who are Canadian residents will become taxable on their worldwide income, whereas non-resident employees are taxable only on their Canadian source income, which would include any remuneration received for employment duties that are exercised in Canada. Tax treaties may provide some relief and may deny Canada the right to tax non-resident employees who are temporarily working in Canada if they are in Canada for less than 184 days and their remuneration is not paid by a Canadian resident or borne by a Canadian branch. Again, this is very fact specific. This is the general rule. The application of the Canada's right to tax on non-resident employees will be based upon the facts applicable to those particular employees. But there is some relief under tax treaties that is very well established in terms of determining liability and obligation and right to tax. So this exemption from Canadian tax, if it is covered by a tax treaty, does not preclude the obligations of the employer to withhold income tax for services performed in Canada. For example, payroll source deductions, payroll taxes, they may still apply subject to certain exceptions. Okay. And sorry, just as we see in, I'll just make sure that I go through actually all of the points on my slide, pardon me. So there are two other things I wanted to cover here. So there's branch tax. So we've talked about what constitutes a permanent establishment. We've talked about what constitutes carrying on business in Canada. So now branch tax. If a non-resident is found to be carrying on business in Canada, there's a branch tax of 25% that applies. This branch tax may be reduced by treaty. And this branch tax is in addition to any federal and provincial income tax that might otherwise apply and be payable. This branch tax is levied on the after-tax business profits of a non-resident foreign corporation who is carrying on business through a branch. Tax treaties may reduce the branch tax payable by a permanent establishment of a non-resident company to 5%. The branch tax is intended to approximate the Canadian withholding tax that would have been paid on dividends paid by the Canadian resident subsidiary to its non-resident parent. So that's the role of the branch tax. That's why it is levied. And again, as I said, it may be reduced by treaty to as little as 5%. In addition, many tax treaties also provide that the first $500,000 earned by a Canadian branch operation is exempt from branch tax. So that is the first $500,000 of net profit, not gross. First $500,000 net earned by a Canadian branch may be exempt from branch tax. So this would be earnings of the branch. So the way to calculate this is the earnings of the branch less the following: business losses, Canadian taxes on profits other than branch tax, profits reinvested in Canada, and then a deduction of $500,000 Canadian. Now, what are the benefits to operating as a branch? It's definitely beneficial in some instances to operate as a branch in Canada if you expect startup losses in your Canadian operations, because such losses can then be consolidated against profits of the non-resident corporation. In other words, they can be applied to the activities and the earnings of the parent or the non-resident corporation. In addition, generally a branch can be converted on a tax-deferred basis into a Canadian subsidiary corporation once the operations become profitable and the $500,000 threshold of earnings has been reached. It is, again, taxed like a Canadian resident corporation. So the branch activities are taxed like a Canadian resident corporation. And where a Canadian branch operation receives passive income, such as rents, royalties, or interest, the payer of that income will be required to withhold and remit non-resident withholding tax to the Canada Revenue Agency. However, if it's attributable to a Canadian permanent establishment, it will be exempted from withholding tax, but instead will be subject to Canadian income tax. There are two primary advantages to using a branch, as just by way of summary. Any Canadian business losses incurred by the Canadian branch would likely be deductible against income earned in the foreign jurisdiction and thereby reduce the overall tax payable by the non-resident. And the non-resident corporation can also generally claim foreign tax credits for any Canadian income taxes paid in connection with the operation of the branch. So now we'll move to a subsidiary. A subsidiary is, of course, a separate legal entity. It is a corporation that is incorporated in Canada and is a separate legal entity with separate legal existence and all rights, powers, and privileges of a natural person. And as Taras mentioned, there are federally incorporated companies, or you can incorporate provincially. And in Ontario, the residency requirements for directors, of course, has been recently eliminated. So in Canada, taxes are levied, again, as I previously stated, at the federal, provincial, and municipal levels. So all of these taxes potentially would apply to a subsidiary corporation depending on the type of income that it carries on. Under the Income Tax Act, the taxation of a corporation will vary depending on the jurisdiction of incorporation, the type of corporation, the type of income, and the activities carried on by it. And again, it is taxable on its worldwide income as a Canadian resident. Where there might be foreign source income that has been subject to foreign taxes that have already been paid, generally a Canadian subsidiary corporation is able to claim a foreign tax credit on any income that it must report that's already been taxed in the foreign location. The combined federal and provincial income tax rates range between 26 and 31%, depending on the province or territory in which of incorporation and also in which the business is carried on. Any initial operating losses of a Canadian subsidiary are not available to offset the parent's profit. So it's important from a reporting and filing perspective, whereas in a branch, the losses of a corporation are generally available, the losses of a branch are generally available to be used to offset income of the foreign corporation. In a subsidiary, generally, losses of the Canadian subsidiary are usually not available to offset the non-resident parent corporation's income. And it may be possible for the parent corporation to claim a foreign tax credit for Canadian income and withholding taxes that are paid by a Canadian subsidiary. This will depend on, of course, whether there is a tax treaty and the tax treaty terms. Okay, so we'll talk about withholding tax. A Canadian resident corporation is required to withhold tax on payments that are made to non-residents of Canada. And these include dividends, interest, rents, and royalties that are derived from sources in Canada. The general withholding rate is 25%, but can be reduced by tax treaty. There is no withholding tax on interest paid to arm's length non-residents. That was eliminated in 2008. However, where withholding tax is paid, there is withholding tax on interest paid to related parties. The rate of withholding tax for interest paid to related parties can also be reduced by tax treaty to generally about 10%. If a parent company provides management or other administrative services to a Canadian subsidiary, and if the Canadian subsidiary pays management fees to the non-resident, then these management fees would also be subject to withholding tax, unless they represent reimbursement of specific expenses. Management and administrative fees are generally deductible from income of the Canadian subsidiary corporation. it is important to, in documenting and in setting up non-resident parent sub or intercompany charges, that we have to comply with international transfer pricing. And the Income Tax Act contains detailed provisions regarding international transfer pricing. For example, it is important that the basis for any management and administrative fees that are charged are properly documented in accordance with the provisions of the Income Tax Act. Otherwise, significant transfer pricing penalties could be applicable. To the extent that management and administrative fees charged to the subsidiary corporation are unreasonable, that portion of the fees would not be deductible by the Canadian subsidiary and will be treated as a dividend and subject to withholding tax. So again, transfer pricing is an important consideration. If you have, so let's talk a little bit about other ways that you can get income back to the Canadian parent. So repatriation of profits, of course, is probably a very important consideration in setting up a Canadian subsidiary. You want to be able to make sure that you can bring the money earned by the Canadian subsidiary back to the parent corporation in the most efficient way possible. So we've talked about dividends. I'm sorry, we've talked about withholding tax. So dividends are generally subject to, again, that 25% withholding tax, which is our base level if no tax treaty applies. And this applies to dividends that are paid by a Canadian subsidiary to its non-resident parent. So as I say, the rate may be reduced by tax treaty. For example, under the Canada-US tax treaty, the rate of withholding tax on dividends is reduced to 5%. Paid up capital. Paid up capital is obviously what has been contributed by way of capital to capitalize or set up the Canadian subsidiary operations by the foreign parent. These can be distributed from a subsidiary to the parent free of withholding tax, even if the subsidiary has undistributed earnings and profits. We talked about management fees, rental, and royalty payments a few minutes ago. These also, again, subject to 25% withholding tax with a reduction to potentially available under tax treaties. Another thing that is important to be mindful of are intercorporate loans. We have thin capitalization principles in Canada, which essentially put limits on the ratio of debt to equity in setting up a Canadian subsidiary entity. So if the parent corporation has sufficient surplus funds, it should consider financing the subsidiary by lending to the Canadian subsidiary. Any related interest charges can be used to repatriate profits on a pre-tax basis, potentially providing significant tax advantages. The ability to finance Canadian operations with debt, however, is significantly restricted by the thin capitalization rules that are found in the Income Tax Act. These generally serve to limit the deductibility of interest paid to a non-resident parent by the Canadian subsidiary. The ratio is 1.5 to 1. Where the debt to equity ratio exceeds 1.5 to 1, the interest deduction is going to be limited and it's going to be reduced based on the ratio of the excess debt amount over its total interest-bearing debt. I won't say any more about that, but just want you to be aware that there are a lot of potential traps in the Income Tax Act with respect to the different ways in which one can finance and capitalize a Canadian entity, Canadian subsidiary. Okay, so we will, I'll just touch on the last 2 points. Payroll tax. So to the extent that a subsidiary has employees, then as previously noted, payroll tax will apply. So that will be Canada Pension Plan, employment insurance, and income tax remittances. And in Ontario, employer health tax, depending on the amount of earnings of the subsidiary corporation. And those will be the responsibility of the Canadian subsidiary to withhold and remit to the Canada Revenue Agency in respect of its employees. And finally, filing requirements. A Canadian subsidiary corporation will be required to file a Canadian tax return to the extent that it carries on business that provides taxable goods and services. It will be also required to prepare and file a GST, a goods and services tax return. So it is subject to all the regular filing requirements of all other Canadian corporations. Okay, so now we'll move on to goods and services tax. The goods and services tax is a value-added tax of 5% at the federal level. There are 2 component parts to the goods and services tax. There is a federal component and potentially a provincial component, which is the provincial sales tax that in Ontario is harmonized with the federal tax for an overall tax of 13%. And that's paid on goods and services that are performed in Ontario. So if you go to the store and you buy a taxable item, it's subject to GST of 13%, for example, in Ontario. So non-resident corporations that have a permanent establishment in Canada are deemed to be resident in Canada for GST purposes, and therefore they may be required to register for and collect GST on all taxable supplies of property and services made through the permanent establishment. So again, just important to note that it applies to not only goods that are sold, tangible goods, but it also applies to services that are being provided. So for example, legal services are that are rendered in Ontario to Canadian resident entities are subject to goods and services tax. So it's not just on goods, it's also on services that are being performed. Now, if a non-resident does not carry on business in Canada and has not voluntarily registered for GST, then any supplies made in Canada by the non-resident are deemed to be made outside Canada, and the non-resident is not required to collect tax on those supplies. So I've already covered what is the GST versus the HST. So the GST is the value-added tax of 5%. And in Ontario, the sales tax is added to the GST for a harmonized sales tax of 13%. So it includes the federal value-added tax plus the provincial sales tax for 13% total tax on goods and services in Ontario. There are some differences between what is considered to be carrying on a business in Canada for GST purposes versus for income tax purposes. So for GST purposes, it's necessary to consider whether the non-resident person is carrying on business in Canada and whether the non-resident is engaged in a business and whether that business is carried on. So as you can see, there's multiple layers of definitions here. So the definition of business in the for goods and services tax purposes differs from the same definition of that same term in the Income Tax Act. So for GST purposes, carrying on business means that the business activity in question is done regularly or on a continuous basis. So it's important to note here that you may not be found to be carrying on a business in Canada for income tax purposes, but you still may be found to be carrying on business in Canada for GST purposes. So it's important to ensure that both aspects are looked at in making that determination of your tax liability. The mere fact that a non-resident person undertakes an activity that falls within the definition of a business does not mean that the business is being carried on in Canada. There are a number of factors that will be considered in determining whether a non-resident person is carrying on business in Canada for GST purposes. And I won't list them all, but I'll just give you some examples. The place where agents or employees of the non-resident are located, the place of delivery of the goods or service, the place of payment for the goods or service, the location of assets, the place where business contracts are made, the location of a branch or office, the place where services are performed, and the place of manufacture or production. So all of these could potentially be considered in making the determination of whether, in fact, a business is being carried on for GST purposes. The importance or relevance of a given factor in a specific case will depend on the nature of the business activity under review and the particular facts and circumstances of each case. So again, my favorite phrase, it depends. It's very fact specific. Okay, so the general rule in the Excise Tax Act, which is the act that applies for the GST, is that everything is taxable unless it is either exempt or taxable at a rate of 0%. And I will explain the difference between the two. So most property and services that are supplied in or imported into Canada are subject to GST. So the following are examples of taxable supplies: sales and rentals of commercial real estate, sales and leases of automobiles, car repairs, taxi or commercial ride-sharing services, publications such as books, magazines, and periodicals, the rights to operate franchises, and hotel accommodation. So those are examples of taxable supplies. Then there are certain supplies that are taxable, but at a rate of 0%. This means that you do not charge GST on these supplies, but you are able to claim an input tax credit for the GST paid on property and services acquired to provide these supplies. Examples of zero-rated supplies include basic groceries, certain agricultural products such as wheat, grain, raw wool, and dried tobacco leaves. Prescription drugs and drug dispensing services are zero-rated. And then the last category are exempt supplies. Exempt supplies are supplies on which no GST or HST applies. These are almost all exclusively medical, health, dental services, educational services, and services provided by financial institutions. So these are, again, depending on the nature of your business and the type of business that you carry on, you may not be subject to GST, or you may subject to GST at a 0 rate. All right, registration requirements. Registration requirements are, you have to register for GST if you provide taxable, including zero-rated supplies, you make taxable supplies, or you sponsor or host a convention in Canada, and more than 25% of the delegates are Canadian residents, or you solicit or offer for sale in Canada books, newspapers, magazines, periodicals, or similar printed publications. The companies will register for the GST as single entities. Branches and divisions usually do not register separately. You do not have to register if you are a non-resident who does not carry on business in Canada, or you are a non-resident who sells taxable real property in Canada other than in the usual course of business. You also don't have to register if you are a small supplier. A small supplier is someone who meets one of the following conditions. You are a sole proprietor, and the total amount of your revenue is $30,000 or less. You are a partnership or a corporation, and the total amount of your revenues is less than $30,000. Or you are a public service body like a charity or a not-for-profit, and the total amount of all your revenues is $50,000 or less. The reporting periods and filing requirements are assigned at the time of registration, and they're determined based on your total revenue. So you can be an annual filer, you can be a monthly filer, you can be a quarterly filer. That's determined at the time that you register, and you will be asked on your estimated revenue from your taxable supplies, and then assigned a filing period, a reporting period. The filing and remittance due dates will be based on your reporting period. Directors of corporations may be held personally liable for unremitted GST. So it's very important. The GST is considered to be held in trust for the Government of Canada, and therefore it's important that it is remitted regularly and promptly. And arrears in remittances can, the CRA can potentially hold directors of corporations personally liable. Of course, penalties and interest may apply for late filed or unremitted GST, and there is a requirement to maintain adequate books and records by every person who carries on a business or is engaged in a commercial activity in Canada. And these books and records must be kept for a period of about 6 years. Okay, not many more slides to go. I'm going to touch on the balance of these relatively quickly. The nuts and bolts of what I wanted to say were really with respect to the taxation matters. These are simply other tax things that you probably should be aware of. So payroll tax, I've already talked about this a few times, is employer and employee contributions towards Canada Pension Plan and employment insurance. And then in Ontario, we have something called employer health tax. In Canada, an employer is required to remit both the employer and the employee contributions. They're responsible for both of Canada Pension Plan and employment insurance. So Canada Pension Plan, as you probably guessed, is our national retirement fund, and everyone is required to contribute to that. And then employment insurance is a fund to help pay workers who may find themselves temporarily unemployed. So if you are an employer, you are required to pay into that as well. Employer health tax. It's a payroll tax that is based on remuneration that's paid to employees and to former employees. The employer health tax is payable if you are an employer. So first you have to be considered an employer, pardon me. And you have employees who physically report to work at your permanent establishment in Ontario. You have employees who are attached to your permanent establishment in Ontario, or you have employees who are paid from or through your Ontario permanent establishment, but they may not report to work at any of your permanent establishments. There is an exemption. The exemption amount was $490,000. So in other words, if your revenue was less than $490,000, you didn't have to pay employer health tax. That was increased to an exemption amount of $1 million in 2020 as a consequence of COVID, and it's still at that level. Like GST, directors can be held personally liable for unremitted payroll taxes, but there is a due diligence defense available. So in other words, if the directors are able to show that they were duly diligent in managing the affairs of the corporation with respect to the remittance of payroll and payroll taxes, they can potentially escape personal liability for unremitted payroll tax. Okay, I'm going to talk relatively quickly about withholding tax. So I've already talked about the 25% withholding, so I will not repeat that. We've already covered payments to non-residents, rents, royalties, dividends, and interest. I'm going to instead, and we've talked about thin cap. So I'm just going to focus on Regulation 105. Regulation 105 is, it applies to branches. So where a branch operation is being used, the corporation that operates the branch is usually a non-resident for Canadian tax purposes. As a result, payments received by the branch for services rendered in Canada are subject to withholding under Regulation 105. This tax is on account of any applicable Canadian income tax payable by the non-resident by reason of carrying on business in Canada, and is equal to 15% of the amount paid to the branch for services rendered in Canada. And it has to be remitted to the CRA by the person who is paying for the services. So in other words, you have a Canadian branch, it is providing services in Canada. A person is paying the Canadian branch for those services, but they have to withhold 15% from the invoice or the bill and remit that to the CRA on account of Regulation 105 withholding tax. It is administratively burdensome for payers dealing with non-residents and carries with it significant penalties. So the obligation for Regulation 105 is on the person who is making the payment for the services. So if they do not know that the entity that they are dealing with is a non-resident, is a branch of a non-resident corporation, they have no way of knowing that they are required to comply with Regulation 105. So it is a potential tricky situation that you must be aware of in connection with dealing through a Canadian branch. Again, because the obligation is on the payer to withhold and remit that 15% withholding tax under Regulation 105. So if a non-resident corporation is going to be providing services rather than goods to Canadian resident customers, it is usually preferable for a Canadian subsidiary corporation to be utilized rather than a branch in order to avoid Regulation 105 withholding tax. Okay, this I'm going to talk about quite quickly. There are tax treaties that Canada has entered into, which serve to obviously eliminate double taxation and reduce withholding tax. And then there is another type of agreement called the Tax Information Exchange Agreement, which are mechanisms, just as they sound, to exchange information with tax haven countries. So in other words, low tax or no tax jurisdictions. Tax treaties are self-explanatory. I'm going to speak just for a minute about tax information exchange agreements. They've been in force in Canada since 2011. There are 23 tax treaties currently, there are 94 tax treaties and 23 tax information exchange agreements in force. These allow for automatic exchange of information between multiple jurisdictions, and it allows the parties to share information relevant to the determination, assessment, and collection of taxes, the recovery and enforcement of tax claims, and the investigation or prosecution of tax matters. TIAs encourage foreign countries by extending favorable exempt surplus regime to foreign affiliates resident in countries that have a TIA with Canada. So in other words, from a repatriation of profits perspective, if you're in a country that is a no tax or a low tax jurisdiction and you have a TIA in place, depending on the negotiation of the terms of the TIA, a company that's operating in a tax haven jurisdiction can repatriate profit to a Canadian resident parent, for example, or a Canadian resident company by categorizing that profit as exempt surplus and being entitled to get the benefit, excuse me, of the more favorable regime. Generally, dividends received by a Canadian corporation out of exempt surplus of a foreign affiliate are not taxed in Canada. So it's a bit of a carrot being provided to no tax and low tax jurisdictions who have Canadian parent companies here to encourage them to both enter into tax information exchange agreements and also to get the benefit of some tax treaty exemptions for repatriation of profit to Canada. Okay, the last thing I want to talk about, and I'm going to talk about it for about 1 minute, because I see that we're all really quite over time, and I thank you for your patience, is the Investment Canada Act. Now, this is not a taxation matter, but I wanted to just highlight it because it is relevant, and I thought this might be kind of the best forum to bring it up in the tax discussion. So the Investment Canada Act is an act that applies to every foreign acquisition of a Canadian business and any investment to establish a new business in Canada. So depending on the nature of the business that you're going to set up, you may be subject to the Investment Canada Act. So very briefly, I'm just going to tell you the applicability. It applies when a non-Canadian, in other words, a non-Canadian controlled entity, establishes a new business in Canada or proposes to acquire control, either directly or indirectly, of an existing Canadian business. And a Canadian business is defined as a business carried on in Canada that has a place of business in Canada, an individual or individuals in Canada who are employed or self-employed in connection with the business, and assets in Canada that are used in carrying on the business. Note that the Investment Canada Act applies even if the Canadian business being acquired is not Canadian controlled. Now, there are certain financial thresholds for review. So there's different categories of review depending upon the financial threshold and the type of business. And I will not, in the interest of time, go over them right now, but I will just highlight to you that depending on the nature, again, depends on the nature of the investment or the business that is sought to be carried on in Canada, you may have to either go through the notification process or the application process. And again, I've just defined what a Canadian business is. So that's, there are also certain criteria that apply to cultural businesses, for example. So it is a rather wide sweeping statute, and it does have potential application to any business sought to either be established in Canada or an investment in a Canadian business. So I wanted to make you aware that that is something that you might also need to be cognizant of. And that is the conclusion. I'm happy to take any questions if you have them now. Otherwise, of course, you are free to reach out at any time to me or to any of us in the business law group. And thank you very much for your time and your attention and your patience in listening to tax talk for an hour.
Thank you so much. Perdón, muchas gracias, Sabina, por tu intervención. Sí tenemos una pregunta y dice, inversiones en fondos mutuos,
Okay.
offshore para Canadá. ¿Pueden pagar impuestos en Canadá si el inversor es residente o si residiendo en el extranjero decide que así sea, estando iniciando un proceso de inmigración?
I'm not sure I completely understand the question. Are you asking if a mutual fund can invest in Canada or if a person outside of Canada can invest in a Canadian mutual fund?
Dice, inversiones en un fondo offshore. Fondos de inversiones offshore, ¿pueden pagar impuestos en Canadá? Vamos por partes.
Can they invest in Canada?
Ujú.
Yes, they can, subject to, so it depends. If you're looking to, I'm sorry, I hate saying it depends all the time, but it does depend. If you are looking to invest in a Canadian business in the sense that you are like a venture capital type entity, then you'll have to comply with the Investment Canada Act, and you're going to have to also probably comply with the provisions of either the Canadian Securities Act or the Investment Funds in Canada Act, depending on the size of the investment. So that's the securities, you'd have to comply with the securities laws. If you were looking to simply invest in an existing Canadian fund or Canadian, whether it's a hedge fund or VC fund or something like that, I think you still also would have to comply with the Canadian Securities Act or the Investment Funds in Canada Act, depending on the circumstances. So yes, of course, you can invest in Canada, but I'm afraid that I can't, outside of taxes, this is something that's outside my knowledge base. I welcome anyone who may know the answer on the panel to jump in, but I'm